Okay, so someone hands you a gold mine in Western Australia. Maybe it's a working pit near Kalgoorlie. Maybe it's a played-out lease in the goldfields, or a discovery a junior explorer ran out of cash to build. However it happens, the mine is yours. The gold is in the ground. And in early 2026, the gold price in Australian dollars hit an all-time high of around $8,500 an ounce, the richest gold has ever been in the currency you'd actually get paid in. You own a piece of dirt full of the stuff. So, you're rich, right? Maybe. And the reason it's only maybe, even at record prices in the world's second largest gold-producing nation, is the entire point of this. Because Australian gold companies are sitting on millions of ounces that went broke. And in 2025, with gold near its highest price in history, one of Australia's newest, highest-grade mines had to raise emergency money at a discount and put itself up for sale. Not because it ran out of gold, because of a decision made in an office, not underground. By the end of this, you'll understand where every dollar in an Australian gold mine actually comes from, and why the thing that kills them is rarely the geology. Let's start with what gold in the ground actually is, because it isn't money. It's ore, rock with gold in it, measured in grams per tonne, not grams per kilo, grams per tonne. To get 1 ounce of gold, a coin-sized lump weighing about 31 grams, a typical open-pit mine might have to blast, haul, crush and chemically treat anywhere from 30 to a few hundred tons of rock. The number that decides everything is the grade. In the March 2025 quarter, the average reported mill feed grade across Australian gold mines was about 2.4 grams per tonne. A mine at 1 gram is scraping, a mine at 3 is comfortable, and Bellevue Gold in WA sits on a resource averaging around 9.9 grams a tonne, one of the highest grade mines in the country. Hold on to that name, it matters later, and not in the way you'd expect. Now, before you touch an ounce, you spend. Australia's permitting timelines for a new mine run for years, environmental approvals, native title and land access agreements with traditional owners, water, heritage, mine plans. You're paying consultants, lawyers and engineers the whole time with zero revenue coming in. Before that, you have to prove the gold is even there, and proving it means drilling, hundreds of holes at hundreds of dollars a meter, tens of millions of dollars, and most exploration programs find nothing worth mining. Finding gold and finding profitable gold are completely different things, and the ASX is littered with the second kind. Over 160 gold companies, from megacaps above $30 billion down to micro-cap explorers worth less than $5 million. Most of them burning cash to drill holes that may never become a mine. Say it works, now you build. A modern Australian gold operation, the pit or the decline, the crushers, the grinding mills, the processing plant, the tailings dam, the camp, runs into the hundreds of millions, sometimes over $1 billion, before it pours a single bar. And because most of these sites are remote, you're building a small town, fly-in, fly-out camp, power, water, roads. FIFO labour is one of the highest costs in the country, and in a boom it only gets worse. Producers were reporting labour cost rises of 3 to 4% going into 2026, with contractors pushing higher. The industry rolls all of this into one number, the all-in sustaining cost, the AISC. Everything it takes to continue producing an ounce, including the sustaining capital and the eventual cost of closing the land and rehabilitating the land. In Australia in 2025, AISC ranged widely. The best low-cost operations, Mount Magnet at Ramelius and Capricorn's Karlawinda, came in at around $1,200 to $1,400 an ounce. The big diversified miners, like Northern Star, guided closer to $2,300 to $2,700 because scale brings complexity. So, picture the spread at, say, $5,800 gold. A low-cost mine is banking over $4,000 an ounce in margin. A high-cost one, half that. Both look fine at $5,800. Wind the clock back to 2016, when gold averaged about $1,680 an ounce, and the high-cost mine is dead and the low-cost one is barely breathing. Same rock, different decade.
That's the first thing people get wrong. The richest gold mine is not the one with the most gold. It's the one that can pull it out of the ground for less than the market will pay and stay alive when the price falls, because it always eventually does. Now, here's the part that's uniquely Australian, and it's the reveal that changes how you should look at every gold miner on the ASX. You do not really own a gold business, you own a leveraged bet on the Australian dollar gold price, and that price is two bets stacked on top of each other. Gold trades globally in US dollars, but an Australian miner sells in US dollars and pays its costs, wages, diesel, contractors, royalties, in Australian dollars. So what actually lands in the bank is the US gold price divided by the currency, which means an Aussie gold miner is simultaneously betting that gold goes up in US dollars and that the Australian dollar stays weak. When both go your way, it's a windfall. Look at what just happened. In January 2026, US gold hit a record around US $5,600 an ounce. But because the Aussie dollar was weak at the time, that translated to roughly $8,500 an ounce, an even bigger record in the currency the miner gets paid in. Then, by mid-2026, gold pulled back and the Aussie dollar firmed back towards 69 US cents, a double hit, dragging the local price down to around AU $5,800, roughly 30% off the peak in a matter of months. The miner did nothing wrong, didn't mismanage a thing. Its revenue fell by nearly a third because of a metal price and an exchange rate it has no control over whatsoever. That's the trap at the centre of this business. Your costs are set in Australian dollars, largely fixed and rising with labour and diesel. Your revenue is the US gold price divided by a currency, and it can swing 30% in a season. The gap between those two is where the fortune is made, and it moves for reasons that have nothing to do with how well you run the mine. So what do miners do when they're terrified of a swing like that? They try to lock the price in, and that, not bad geology, not a collapsed pit wall, is what has killed more Australian gold miners than anything else. It's called hedging, selling your future gold today at a fixed price through forward contracts, so you know exactly what you'll get. It feels like prudence. It is the single most dangerous thing a gold miner can do, and Australia has a graveyard to prove it. Meet Sons of Gwalia, a century-old name in the WA goldfields, and by the early 2000s, Australia's third largest gold producer. To protect itself, it built one of the biggest gold hedge books in the world. It had sold enormous quantities of future gold forward at fixed prices. Then, in 2004, it revealed a shortfall in its reserves. It had promised to deliver more gold than it could actually dig out of the ground. Suddenly, it owed gold it didn't have at prices it couldn't meet, and its bankers refused to grant it breathing room. It collapsed into administration, owing more than $800 million, at the time one of the largest corporate failures in Australian history. Its gold division was picked off by a rival for scraps. The company wasn't destroyed by the geology, it was destroyed by its own hedge book, by a financial bet made in a boardroom. You'd think everyone learned. Now watch it happen again at record prices 20 years later. Bellevue Gold, that high-grade Western Australian mine, 9.9 grams a tonne, one of the newest producers in the country. To secure the loan that built the mine back in 2021, it had hedged a big slice of its future production at prices around $2,600 to $2,800 AU dollars an ounce, reasonable at the time. Then gold ran to nearly 4,800 AU dollars, and those hedges became a millstone. Every ounce it had promised at 2,700 was an ounce it couldn't sell at 4,800. Then in early 2025, it hit operational trouble, lower grades than the model said, and cut its production guidance twice, with AISC blowing out from around 1850 to 2475 AU dollars an ounce. Caught between a hedge book underwater by roughly $1,000 an ounce and a mine producing less than promised, it was forced into an emergency capital raising, about $156 million in new shares, sold at a 26% discount, most of it spent buying its way out of its own hedges just to get exposure to the record price everyone else was enjoying, and it put itself up for sale.
Same lesson 2 decades apart. The mine that locks in a safe price is the one that goes broke when the price runs away from it. Hedging doesn't remove the risk, it just swaps a price you can't control for a promise you might not be able to keep. And there are 2 more costs that are pure Australia. First, royalties. In Western Australia, where most of the country's gold comes from, the state takes a royalty of 2.5% of the value of the gold you produce. That's off the top, on revenue, before you've counted $1 of cost, and it rises automatically with the gold price. Second, rehabilitation. You can't dig a hole and walk away. Every mine must be closed and the land restored, and the state makes you fund it. WA runs a mining rehabilitation fund that miners pay a levy into every year. That closure cost is baked into your AISC from day one, a liability sitting on the balance sheet before the first ounce is poured. And there's political risk on top. Royalty rates can change, permitting can slow, and the mine is bolted to the ground. You can't move it when the rules move. Now, run the 2 futures honestly. The good version is Northern Star in 2026, Australia's biggest gold producer, around 1.6 million ounces a year, AISC in the 2,300 to 2,700 $A range. Not the lowest cost, but enormous scale, spread across multiple mines, financially flexible enough to ride out a bad quarter. With gold above $6,800 an ounce at one point, it was earning margins of $4,100 to $4,500 on every ounce, throwing off billions in cash and growing its dividend, revenue of $6.4 billion and net income of $3.5 billion in 2025. When you can dig it cheap, sell it unhedged into a record price, and you're big enough to survive a downturn, an Australian gold mine is one of the most profitable assets on the ASX. That's why the majors spent 2025 in a takeover frenzy, Northern Star swallowing the Grey's Hemi project, Gold Fields buying Gold Road, scrambling to own more ounces while the price was high. Now run the realistic version. It's Bellevue or Sons of Gwalia or any of the dozens of juniors that never make it. You built at high cost, your grade came in below the model, your AISC blew out, and you'd hedged, locked in yesterday's price, so when gold hit records, you were the only one in the room who couldn't sell into it. Then the Aussie dollar firmed up and the US gold price pulled back 30%, and the margin you were counting on to service your debt simply wasn't there. Same gold in the ground, same record headline price, but the gap between your fixed Australian dollar costs and your fragile, hedged, currency-exposed revenue closed to nothing. And in this business, when that gap closes, the debt doesn't wait. That's the volatility trap. Costs in Australian dollars rigid and rising. Revenue in US dollar gold divided by a currency, swinging 30% a season. The miners who survive aren't the ones with the most gold or even the highest grade. They're the ones who can pull it out cheap, who don't drown themselves in debt or hedges, and who are big enough to still be standing when the price and the dollar inevitably turn against them. So here's the honest answer to whether an Australian gold mine makes you rich. In a boom, with a low-cost mine, no crippling hedge book, and the scale to survive a downturn, yes, it's among the most profitable things you can own in this country. But you're really not buying gold in the ground. You're buying a leveraged bet on the US gold price divided by the Australian dollar, taxed by a state royalty off the top, carrying a rehabilitation bill from day one. And the fastest way to lose it isn't hitting bad rock. It's a spreadsheet decision to sell tomorrow's gold at today's price, made by people who were sure the price would never run away from them. So here's where you stand. If you're weighing a gold miner, the mine or the ASX stock, don't start with the ounces in the ground or the record gold price on the screen. Start with the AISC against the Australian dollar price and then ask two questions. How much is it hedged and how much debt is it carrying? Because that's what decides whether a record gold price makes it rich or buries it. Put that number on the screen, that's your Aussie money standard. Not the ounces and not the headline price, but the margin and the hedge book underneath them.